Hello class, welcome to my video. This video is for your chapter 9 in your financial accounting 1. So what you can learn in this chapter 9? Chapter 9 is about sole proprietor financial statement. Upon completion of this chapter, students should be able to applying the depreciation, bad and doubtful debts, NRV, accruals and prepayment in the preparation of sole proprietor financial statement. So basically, the things that you learn from chapter 1 to 8 will become your chapter 9. So in chapter 9, we are going to prepare a complete financial statement for a sole proprietor. So let's see. Sole trader's financial statement. In this chapter, you are required to prepare a complete set of financial statement for sole trader by applying the following concept. You are required to apply depreciation concept, bad debts recovery, and provision for doubtful debts concept, net realizable value of inventory, and accruals and prepayment. So I have do some summary. Those summary are from your previous chapter. For example, depreciation is from your chapter 5, provision for doubtful debts from your chapter 6, chapter 7 for your NRV of inventory, and chapter 8 will be your prepayment and accruals. So what is the advantages for a sole trader? A sole trader has complete control and decision making power over the business. They can sell or transfer, and this is based on the discretion of sole trader. It means that you are the only one who can make the decision. Minimum legal costs for forming a sole proprietorship and few formal business requirements. Those are the advantages for a sole trader. These advantages, the sole trader of the business can be held personally liable for the debts and obligations of the business. Additionally, the risk extends to any liability incurred as a result of acts committed by employees of the company. It means that as the owner for a sole trader, you have unlimited liability. Any loss or debts in the business, the owner have to use their own wealth or use their own money to pay for the company. All responsibility and business decision fall on the shoulder of the sole trader because you are the only one, so you have to make all the decision and take all the responsibility. And next one, difficulty in external fundraising. Because you are the sole trader and your financial statement is not required to audit, so this may be very difficult for you to get external fund borrowing, such as get the money from bank for your business purpose. Next, so this is a sample of your income statement, and from what you see here, this is very similar in your chapter 3. The format will be the same, and this is a sample of your financial position. The only difference as compared to your chapter 3 is only the presentation of non-current asset. So non-current asset, we need to split into cost, accumulated depreciation, and net book value. And this you have learned this in your chapter 5. And let's practice this 9.1. Below is the extracted trial balance of Edwin Jeans Enterprise for the year ended 31st December 2017. So this is a trial balance of the company. The following are the adjustments that without taken into the above account. It means that we have to adjust the information here in the trial balance. Requirement: please prepare the following statement for Edwin Jeans Enterprise as at 31st December 2017. So we are required to prepare income statement and statement of financial position. So let's have a look. For a better presentation, I will show my answer in the Excel. Right, I will show my answer in the Excel. So let's look at the adjustment one by one. The first adjustment, the closing inventory as at 31st December 2017 are 40,000. Edwin is in the view that a batch of the product which costs 5,000 can only be sold at 4,000 due to over season. It means that the product is out of fashion. So we have to take in to find out what is the real closing inventory for the company. So this is classroom exercise. This is classroom exercise 9.1. So the first adjustment is related to your closing inventory. So it says that the total stock they have is 40,000, and inside this 40,000 there is a batch of stock. The cost is 50,000, but the selling price is 4,000, and the remaining balance for the stock is 35,000. So these are the information we have. So this additional information, they want us to identify what is the correct closing inventory value. So let's look at this portion. We know that in order to value the closing inventory, we should value at the lower of cost or net realizable value. Net realizable value refers to your future estimated selling price less cost of completion and less the cost incurred for the sales. So let's look at here. The selling price we can refer to NRV. So cost is 5,000, NRV is 4,000. Which one to use by applying the concept lower of cost or NRV? The answer is we should use the NRV 4,000 as the latest value for the closing inventory. So what is my total closing inventory? My total closing inventory will become 4,000 for the first batch of the product, and for the remaining 35,000. So total 39,000. This will be my closing inventory value. No adjustment required for this 35,000 because there is no problem with this batch of the product. Alright, so we have done the first adjustment. The first adjustment shows that the closing inventory is 39,000. So we can record the closing inventory as 39,000 here. Next, the useful life of office equipment is 5 years. Edwin used reducing balance method to calculate the depreciation. The scrap value of the office equipment is 5,000 based on the estimation. So second adjustment is depreciation, and depreciation by using reducing balance method. So formula for reducing balance method, we know that is cost minus accumulated depreciation and divided by the useful life. So let's look at the question. Let's have a look on the office equipment. So we know that office equipment, the cost is 35,000, and the total accumulated depreciation up to the previous financial year is 12,000. Useful life is 5 years. So we apply the formula in this way. 35,000 minus 12,000 divided by 5. So let's see the calculator. 35,000 minus 12,000 and then divided by 5. 4,600. So this will be the depreciation for the office equipment. And you may ask the question, sir, how about the scrap value? Is the scrap value relevant in the computation of depreciation under reducing balance method? The answer is no, irrelevant. So we no need to consider scrap value when we compute the depreciation for office equipment, because the company is using reducing balance method. So now we have to reflect this 4,600 in the trial balance. So first of all, we have to provide the double entry. The double entry for a depreciation is we debit the depreciation account. Depreciation is your expenses, 4,600. Next, we credit to accumulated depreciation of office equipment, another 4,600. So this is the double entry. So the next step I'm going to show you is how we adjust the trial balance. So you can adjust the trial balance here. So first, the first entry is debit a depreciation, 4,600. Let's have a scan. Do we have depreciation in our trial balance? No, right? So if there is no depreciation, then we have to add a new one, depreciation. And debit 4,600, so we put on the debit column 4,600. And then for the credit, do we have accumulated depreciation of office equipment account? If we yes, then here we add the 4,600. We add a debit 4,600 and then we add a credit of the 4,600 under the accumulated depreciation of office equipment account. So by doing one add on the debit, one add of the credit, our trial balance will remain the same. I repeat, by adding one entry on the debit, another entry on the credit with the same value, 4,600, our trial balance will remain the same. So this is how we adjust our trial balance, right? Because this trial balance is not complete, so we have to base on our additional information and adjust this amount in the trial balance. Next, the next entry is regarding the rental. The rental expenses per month is 5,000. So the third one is regarding the rental expenses. So let's look at what is the payment that we make. So rental expenses 5,000 per month, and we have paid 66,000. So the amount that show in your trial balance will be the paid amount. The amount that show in your trial balance will be the paid amount. So let's have a comparison. By right, my rental expenses will be 12 times 5,000. Why 12? Because we have 12 months in a year, so 60,000. And the actual payments that we make is 66,000. So we have a difference by 6,000. This 6,000 is pay more or pay less? The answer is expenses pay more, because payment 66,000, but the actual is, but the by right amount should be 60,000. So this is known as prepayment. And then we have to provide the double entry for your prepayment. The double entry for your prepayment will be debit prepayment and credit to your rental expenses. The amount 6,000. So next we have to reflect this entry in our trial balance. So let's have a scan. In our trial balance, do we have any prepayment here? No, right? We don't have prepayment. So here we add prepayment, 6,000 on the debit. Next, we have to credit rental expenses 6,000, right? So we find the rental expenses here. For your information, one account only have one entry. one account only have one amount. Either the amount is on debit or credit. I repeat, one account will only have one total amount, and this amount either is on the debit or credit. So according to this adjustment, by right we should credit 6,000 here, right? By right we should, on the credit side, we should put a 6,000. But this against the rules, because we say that for one account we can only have one total amount. Because when you have a debit 66 and a credit 6,000, which one to use? Alright, so we have to net together. So if you have a debit 66,000 and a credit 6,000, so this is the lesser side, this is the higher side, so you net this 6,000 from the credit to the debit. If you change the direction, this will be from a positive amount and change to a negative amount. It means that by netting off your debit and credit, the net amount in the debit side will be 60,000. I repeat, one account is only have one total amount. This total amount must be either in debit or credit. We cannot have one account with two balances. So we have a debit 66, credit 6,000. So when we net off, right, we use the lesser side, net off with the higher side. So we minus a 6,000 here. So the net balances will be 60,000 on the debit. I hope you can understand this. Next, the next adjustment is unpaid salary and wages as at 31st December 2017, 12,000. So unpaid salary and wages. So by right, we have to pay 12,000 to our employee as the salary or wages. However, we did not pay, right? The actual payment is 0. So from here, we know that the different amount is 12,000, right? And this 12,000 is expenses pay more or expenses pay less? The answer is expenses pay less. By right, we have to pay 12,000 to our worker as the salary and wages for 31st December 2017. But in actual, we did not pay anything to them. We only pay them in next year. So for expenses pay less, the term that we use is called accrual. Double entry. The double entry is we debit the salary and wages account, 12,000, and we credit to accrual, 12,000. So now we have to reflect this double entry in our trial balance. So let's have a look. Do we have accruals here? No, right? So we add accrual. Accrual 12,000. Sorry, 12,000 on the credit. And then for the debit, we add on the same direction. So our salary and wages account become 99,040 now. Next, the next information is regarding your term loan. The term loan interest remain unpaid during the year. So let's have a look. Your term loan 6% repayable in the year 2020. The amount that you borrow is 50,000, and this information say that you have unpaid the term loan interest during the year. So now we have to determine how much of the interest that we need to pay. So number 5, term loan interest. So the principal or the amount that you borrow from bank is 50,000. The interest rate we can identify from the description here, 6%. 6% is the interest rate. So we need to pay 3,000 as the interest for the borrowing. And we can do a comparison. By right, we have to pay 3,000, but actual payment is 0. So we have a difference by 3,000, right? This 3,000 refer to what? Expenses pay less. By right, you have to pay 3,000, but you unpaid during the year. So this is expenses pay less 3,000. So expenses pay less by 3,000. The term that we use is called accrual. So double entry for accruals. We debit term loan interest and we credit to accrual. The amount 3,000 each. Now we reflect this in our trial balance. So we look at the debit side, term loan interest. Do we have term loan interest here? No, we don't have term loan interest here. So we add term loan interest, 3,000 on the debit. And for the credit, we have to credit accruals, right? And we already have one accrual here. So we just add 3,000 on the credit. Next, the next adjustment is related to your provision for doubtful debts. Edwin is of the view that 10% of the provision of doubtful debt shall be provided on the trade receivables as at 31st December 2017. So this is adjustment number 6. Adjustment number 6, provision for doubtful debts. So we know provision for doubtful debts, the formula, we use trade receivables minus bad debts if we have, and multiply with the rate of provision for doubtful debts. Let's look at our trade receivables. Our trade receivable is 15,780. 15,780. And do we have any bad debts? No, we do not have any bad debts. So we minus 0. And the rate for provision for doubtful debts, the rate is 10%. The rate for provision for doubtful debt is 10%. So we apply 10% here. Answer 15780 times 10%, 1578. So 1578 will be this year provision for doubtful debts. So we have to scan our trial balance to see whether we have any provision for doubtful debts or not. Do we have provision for doubtful debts? Yes, we have provision for doubtful debts. The provision for doubtful debts at 31st December 2016, this is prior year balances, which is 2,000. So we have to do an analysis. Last year is 2,000. So we have a difference, right? Difference by 422. And tell me, this is increase in provision or decrease in provision? The answer is decrease in the provision for doubtful debts. When you have a decrease in the provision for doubtful debts, this is income for the company. Last year 2000, now is 1578, so you have a difference of 422, and this 422 is an income for the company decrease. So when your provision for doubtful debt decrease, the double entry will be you debit the provision for doubtful debts 422, and then you credit to the allowance for doubtful debts 422. Right, debit the provision, credit the allowance. So let's adjust the debit provision. So let's look at the provision account. By right, we have to put a debit 422. But again, can we have two amounts for one account? Cannot. So we net off the lower side to the higher side. So we net off the 422 here. So we get the net balances is 1578. Next, we record allowance for doubtful debts. On the credit, we will show 422. And this is very important for you to check. Your adjusted amount for your provision for doubtful debts must equals to your this year balances. I repeat, the provision for doubtful debts in your trial balance must equals 1578, must equals to your working. So it means that you have calculated correctly. So we have complete all the adjustment, and let's take a break. The next video I'm going to show you how to prepare the income statement and statement of financial position. So thanks for watching.